Hello friends, this is Gaurav from Lamox Investments, and today we are going to talk about the upcoming union budget which will be placed on the floor of the House on 1st of February 2023 by Honorable Finance Minister Nirmala Sitharaman. So this year's budget is special largely because this is going to be the last major budget by the current government establishment. Next year we're going to have the national elections, and hence next year budget would be a trimmed down budget and only a vote on account. So any major policy announcements, if government of India has to make in a budget, then it will come this year around. So, what we are going to discuss here is what is expected in the budget, what are the key numbers to look at, how it will impact the capital markets, how it will impact the stock markets, what are the key sectors that are likely to benefit from the budget, and sectors that we can possibly avoid. So, in this budget, as I said, is going to be particularly challenging. While Mrs. Nirmala Sitharaman has said in a pre-budget speech that it's going to be a roadmap for next 25 years, and this is going to be possibly a tax benign budget. We can actually see that there are going to be challenges that she will face. On one hand, you have an increased challenge for reviving the growth in a globally complex situation where the war's happening. There is inflation everywhere on the globe. There's supply chain constraints. On the other side, we have the challenges to maintain fiscal deficit, which eats on the revenue collection, as a large portion of the revenue goes towards servicing of the debt that government has to take on its balance sheet in order to service this fiscal deficit. So the challenges are galore, and how Nirmala Sitharaman ji fares in this budget will determine the destiny of India in years to come. So let's look at some critical numbers. In any budget, we have to look at three major aspects. One is the expenditure, second one is the revenue collection, and the third one is the difference of expenditure and revenue, which is popularly known as fiscal deficit. So if we look at the expenditure numbers, this year in 2022-23, Government of India targeted an expenditure of 39.4 lakh crores and had an income target of about 22.04 lakh crores and a fiscal deficit target of about 17.36 lakh crores. They have basically revolved around 15 to 17 lakh crores in last few years, and their effort was to ensure that we remain around that number. And to give credit to this government, they did exceptionally well on the income front. In fact, they managed to exceed the income target, and when this financial year ends on 31st of March, it is a fair possibility that Government of India might exceed its income target by about 3 to 3.5 lakh crores, or net around 2.5 lakh crores in their book. But this entire increase did not translate in reduction of fiscal deficit. The government, as I said, have other challenges, and last year was basically the first year wherein India was trying to come out of the COVID crisis, and the aim was on increasing the growth and at the same time help the poor and the needy people. And a lot of this money, around 1 lakh crores, went on food subsidies and other related things, and hence the fiscal deficit, while it got trimmed, but not by the entire 2.5 to 3 lakh crores, and hence we saw a reduction in fiscal deficit number from around a target of 6.5 lakh crores to around 6.3. So this is itself credible, and full marks to government for policies which helped in reduction of numbers, particularly its revenue generation. Now, let's look at the three main component of income that Government of India gets. One, and basically it's in the form of taxes. Then is the corporate tax. The second one is personal tax, and the third one is GST. And in all the three departments, they did exceptionally well. They realized that while expenditures are not going to decrease, in fact, they will only going to increase. The best way to ensure that government have its finances in order is to place more emphasis on revenue generation, and they were extremely credible in what they did on this front. It's possible that GST collection would be in excess of 9.5 lakh crores this year. Personal taxes would be about 9 lakh crores, and your corporate tax would be around 9.5 lakh crores, and this is quite significant. Now, next year, it's possible that government would be aiming at an expenditure of around 45 lakh crores. The income target would be around 29 to 30 lakh crores, and a deficit number of about 16 to 17 lakh crores. And hence, they would be looking at a fiscal deficit number of about 5.75 to 5.8% of GDP, which would be which would be a fall from the current fiscal deficit numbers of about 6.15% in this financial year, and ensuring at the same time that the Government of India, who had committed to around 4.5% GDP fiscal deficit number over next 2 to 3 years, and that they are on the right path as far as fiscal management, indebted in a significant manner. Another thing which Government of India emphasized in the last budget is that they will go in for increased capital expenditure. In fact, the last budget in the last budget we saw almost a 25% increase in capital expenditure outlay to almost 7.7 lakh crores, and Government of India is well on course to achieve that. These capital expenditure helps in reviving growth in a big way, because it's the money is being spent on various in a very significant way. And what we also see is that this brings employment, this revives growth, and possibly see this capital expenditure increasing to about 9.5 to 10 lakh crores, which will be a further increase of about 25 to 30% over the previous year. This expenditure. Now, this is a very important number. This would help in India, making India the fastest growing economy in the world. This would also ensure that India becomes a giant manufacturing hub with world-class infrastructure. We are looking to occupy a space that China is leaving behind because of environmental issues and high labor cost. Now, it's also that India is looking at China plus one, and be looking at an alternative manufacturing space for the world community. And hence this capital expenditure would ensure that the global companies, the world-class companies, will be looking at India with significant interest, and also ensure that they start investing in India in a meaningful way. So there will be a push for private investment picks, increased incentives for PLI schemes, which has been a hugely successful scheme by Government of India. And this is going to be very important, and I'm very sure that this will pay dividends. Another thing to note is that we expect that there won't be any major tinkering in tax rates. The last year, or in the last year budget too, we didn't see any major change in the tax rates, and it was welcomed by investors across the globe, as well as by the Indian capital markets, and we expect the same. And if this happens, this would be welcomed by one and all, except for the middle class, who would obviously be looking for some benefits. And even if those benefits come to the middle class, or some minor changes here and there, it won't really be a significant dent on any kind of fiscal issues. So we expect no major tinkering on any tax rates, and this would be a welcome move. 95% of income come from other taxes, like as I mentioned, corporate, personal, and GST, and there won't be hardly major tinkering around that. Disinvestment income is very, very small, and so even to be very honest, Government of India has failed miserably in the disinvestment front over the years, despite ambitious targets in the past. But I don't think they will have big targets for disinvestment in the upcoming year. And at the same time, I don't see any major progress happening on this investment side. So, coming to the next year, it's going to be a challenging year, and for the finance minister, it's going to be a challenging budget. Election year, there could be demand from states, there could be calamities, who knows, and there could be increased outlay demand for poor people, social requirements, and other things, and hence challenges remain. But I think this would be a good budget. No major policy announcements can happen right throughout the year. Budget is not really a policy announcement exercise anymore, but more of the numbers and the intent. So what's going to be the impact on the stock markets? We feel no change in taxation would be a welcome move. Markets might take it positively. We remain extremely bullish on certain sectors, and I want to mention those sectors to you. Our existing portfolios would also reflect that. The One of the major sectors that would benefit and is already enjoying the structural changes that have happened and helped the sector is the banking sector. We remain overweight on the banking sector. It has come out of high debts on its book. The government of India has to all the credit that we can give to Government of India. The balance sheet of the public sector banks has improved substantially, and there's credit growth happening after a long, long time, and it's all a welcome sign. There are record profits that both public and private sector banks are generating, and it's all looking great on that front. And we expect the banking sectors to do exceptionally well in the coming year and the years to come thereafter, and hence banking remains a strong choice for us. Another sector that we are keen on is the manufacturing sector. We really think that government steps on the manufacturing side are delivering fruits, and we also feel that India was nowhere really on the manufacturing side. Any step around that is always a welcome change, and we can only grow from here. And like Apple just said last year, that they exported almost $1 billion worth of Apple iPhones from India in the month of December, and they are only creating about 5 to 6% of iPhones from India, and number is likely to become 25%, a five-fold increase in the manufacturing from India. And these are all welcome signs, and that is why we think that manufacturing is going to become big in India, and so manufacturing remains another preferred bet. Another sector that we are very bullish on is essentially the defense side, wherein India has its huge defense requirements because of hostile neighbors, and hence the expenditure around the defense requirement is only going to increase. Earlier we used to import, now we have started manufacturing some portion of it, and I think Government of India has rightfully started manufacturing this portion in India, and this is only going to become bigger and bigger in years to come, and hence some of the important companies on the defense manufacturing side would become extremely critical, and we remain extremely bullish on this sector. This is third, and the fourth sector that we are keen on is the infrastructure sector, with the uh, capital expenditure outlay uh, likely to be around 9.5 to 10 lakh crores. All the infrastructural companies in India and the pace at which we are growing in terms of making highways and you know the roads and the interconnectivity that is happening around India is going to benefit the manufacturing companies in a big way. All allied infrastructural companies like cement and other related companies are going to also benefit, and we remain bullish on that side as well. Last but not the least, we remain extremely bullish on the railway side, and we think that this budget is going to play special emphasis on the railways. There would be more trains, there would be new tracks, there would be widening of tracks, and there would be the latest technology coming on the railway side. The bullet trains would be there, and railway as a sector, there is no private participation, not much of private participation. So the companies which supply to railways, the private companies, and otherwise the government companies which are there are going to benefit immensely from this budget. So these are our sectoral preferences. We remain extremely bullish on India, as I said earlier, but we look at very, very long term. And we are not the daily, weekly, monthly traders. We are investors, and we invest in India from a long term perspective. India has grown at around 15 odd percent. The stock market has also grown. The stock market has grown by 15 odd percent since its inception, and we expect the growth to continue. This growth to continue. In fact, we are going to remain the most important, attractive economy in next 2 decades, and we remain extremely bullish. If you're not participating, then you're losing out in a big way. So that's what is from me at this point of time. Once we have actual budget, and thereafter I'll take you through the final details of the budget, and thereafter we will decide on the next course of action. So hope you liked what I said, and if you have any suggestions, ideas to give, please feel free to share with me. And you have the details of contact details in various ways available on social media as well. And thank you for your encouragement. God bless.